Hi, today I'm going to explain you IFRS 12. But before I start it, let me tell you a very common confusion. Many students think IFRS 12 involves consolidation or a calculation. It does not. IFRS 12 is purely a disclosure standard. It's- It does not change number, it does not require journal entries, and it does not involve any calculation. For exam point of view, we can say that IFRS 12 is tested when the question asks you to explain, describe, or disclose information about a group, such as who controlled, who interested, and what risk exists. Remember one thing: no calculation, no consolidation, only disclosure. That is IFRS 12. Let's move forward and talk about what would you learn after completing this lecture. My main agenda for today's video is definition, scope, core concept, significance, and conclusion. After completing this video, you know what is IFRS 12 and where and why we use it. Let's move forward. Go for our first slide, which is overview. IFRS 12, the companies, what exactly information must be in financial statement about subsidiaries, associated and joint ventures. At least these disclosures were spread across IAS 27, IAS 28 and IAS 31. IFRS 12 bring them all together and add a new disclosure. The most important and the new requirement in this company must clearly explain the judgment they use to decide whether they control another company or not. The rules are introduced after the financial crisis to improve transparency. It helps user understand why management decide to consolidate or not consolidate an entity. And the other point is what changes in financial statement is different decision on control or on control or consolidate. The other point is what would changes in the financial statement if a different decision has been made. Our next slide is objective of IFRS 12. The objective of IFRS 12 is to make sure that the user of financial statements clearly understand a company interest in other companies. IFRS 12 required the companies to disclose information that helps the user evaluate the nature of interest in other entities and the risk associated with those interests. It also helps a user to understand how these interests affect the company, financial position, financial performance, and cash flow. To achieve this object, IFRS 12 required disclosure of significant judgment and assumptions made by management while determining the nature of interest is another entity, the type of joint agreement, the joint operational or a joint vendor do specifically mostly, and whether the entity qualified as an investor entity if applied. And the IFRS also requires a detailed disclosure about the company interest in subsidiaries, joint agreement and associate, and lastly, structure entries that are not controlled by entities. Significance of IFRS 12. IFRS 12 emphasizes that necessary for financial statements prepared to strike the balances between the bundled financial statement. It tells that what information should be disclosed specifically. Let's conclude our topic. IFRS 12 is a disclosure standard that helps improve transparency in financial statement. It required companies to provide a clear information about their interest in other entities such as association, joint arrangement, and structure entities. The main focus of this standard is the significant judgment and assumption made by the management, deciding whether the company control or has a significant influence over another entity. This disclosure helps a user understand the risk related to these investment and how they affect the company financial position and performances and cash flow. Overall, the IFRS 12 help user only see the financial figures but also understand the relationship decision behind those figures. In a one line conclusion, we can say that IFRS 12 does not change the number, it explains the story behind them. I hope you understand that. That's all. Thank you.